Hey everyone, welcome to The Explainer. Today, we're taking an exclusive look inside the actual architecture of a Millionaire's portfolio. We are stepping right past those flashy headlines to examine the underlying blueprint that structured investors use to build, scale, and protect their wealth. We're going to explore the precise, real-world mechanics of how long-term capital is efficiently allocated and maintained. It's going to be a fun one, so let's get right to it.
Okay, let's dive into this by immediately shattering a huge myth, the whole get-rich-quick fantasy. We constantly hear about overnight crypto successes, or someone catching a wildly lucky break on a heavily shorted stock. But research points to a very different reality. Sustainable, real millionaire wealth is actually built on beautifully boring, long-term discipline. It comes down to consistent strategies based on deep diversification and rigorous risk management, rather than trying to time the market or betting the house on a single speculative idea.
To navigate all this, here is the exact 5-part roadmap we'll use to build our financial house today. First, the wealth-building mindset. Second, the millionaire asset allocation. Third, what millionaires actually own. Fourth, habits of self-made millionaires. And finally, protecting the portfolio. All right, Section 1, the wealth-building mindset. Think of this as pouring the foundational concrete for our entire financial house. Because without this structural framework, everything else just crumbles. A millionaire's primary goal isn't actually maximizing returns every single quarter or desperately trying to outpace elite hedge funds. Not at all. Instead, the core philosophy revolves around delightfully growing wealth over time while aggressively minimizing the risk of catastrophic losses. This foundation relies heavily on long-term investing and the absolute magic of compound growth. Capital is spread out for broad diversification, and the focus is squarely on income generation, preserving that initial principle, and staying incredibly tax-efficient. It is a calculated, defensive, yet steadily aggressive approach.
Moving on to Section 2, the millionaire asset allocation. This is where we frame the house, figuring out exactly how to spread capital across different buckets to diversify our risk.
And this brilliantly illustrates the perfect pie of wealth. Now, while every investor is unique, a historically robust model breaks down exactly like this. Stocks serve as the primary engine for long-term growth, taking up roughly 60% of the allocation. Real estate accounts for a solid 20%, giving you a structural hedge against inflation and reliable rental yield. Bonds sit at 10% to provide some crucial portfolio stability during broad market downturns. Cash is deliberately kept at 5% for liquidity. And finally, another 5% is dedicated to alternative investments.
Let's translate those abstract pie slices into hard, tangible numbers by looking at a hypothetical $1 million portfolio. That's 60% in stocks, that is $600,000 quietly compounding in the background. The 20% in real estate translates to a $200,000 equity footprint in tangible property. You've got $100,000 anchored safely in bonds. But notice that $50,000 in liquid cash equivalents like high-yield savings or treasury bills. This isn't just idle money. It is a strategic reserve waiting to be deployed precisely when markets dip. And the last $50,000 in alternatives, whether that's venture capital or commodities, provides non-correlated returns. That just means it often moves completely independently of the stock market, adding a really sophisticated final layer of diversification.
So, Section 3, what millionaires actually own. We've got the framework down, so let's move into the interior of our blueprint and examine the specific assets filling up those buckets. The target here is undeniably high-quality assets. Instead of speculative bets, the focus is on strong businesses with massive global footprints, wide economic moats, and serious recurring revenue. Think about enterprise cloud computing or essential software. These are literal non-negotiable line items for major corporations, providing incredibly stable cash flows. Similarly, dividend-paying companies are highly prioritized for passive income and inflation protection. As global prices rise, these established giants typically increase their payouts, protecting your purchasing power. And within tech, wealth is often deployed right into the fundamental infrastructure of our digital economy. Stuff like artificial intelligence and the highly specialized semiconductors required to run global data centers. Now, when it comes to actually executing this strategy, here is a major surprise. Many self-made millionaires actively avoid the friction of picking individual stocks. Instead, they rely on the elegant simplicity of index funds. An index fund basically lets you buy a fractional slice of the entire market all at once. The advantage is immense. You get incredibly low management fees, instantaneous broad diversification across hundreds of companies, and incredibly steady performance. It completely removes the stress of trying to outsmart highly efficient markets. You're just systematically capturing the overall long-term growth of the broader economy.
Which brings us to a massively important point from Warren Buffett. Time in the market is more important than timing the market. The underlying philosophy here isn't about rapidly trading in and out to catch daily highs and lows. It's about buying fundamentally great businesses and holding them with absolute conviction for decades. Wealth is generated through patient, sustained exposure to growing markets, period.
Let's move to real estate and see how this builds because it relies on the exact same principles of quality and patience. It generally follows a really simple three-step roadmap. Step 1. Buy cash-flowing assets. The focus is squarely on monthly income and reliable rental yields, not just hoping the property appreciates. Step 2. Use leverage carefully. Yes, mortgages mathematically amplify your returns, but successful investors aggressively avoid over-leveraging. They want to make sure their cash flow can easily weather economic storms or high interest rate cycles. And Step 3. Long-term ownership. Holding properties for decades is what unlocks the full mechanics of asset appreciation, steadily rising rents, and massive tax advantages. Section 4. Habits of self-made millionaires. Strategies are literally only as effective as the discipline of the person executing them. So let's look at the behavioral side of things.
When we analyze the actual lifestyle choices that build and maintain this wealth, the reality is a huge plot twist compared to those flashy media stereotypes. Self-made millionaires are incredibly frugal and focused. They live purposefully below their means, they drive reliable, modest cars, and ruthlessly avoid high-interest consumer debt. But listen, this discipline isn't about depriving themselves, it's about freeing up capital. It allows them to consistently invest a massive portion of their income every single month through dollar-cost averaging, which completely removes human emotion from the equation. And critically, they continually reinvest their dividends and profits, allowing the undeniable mathematical force of compounding to do the heavy lifting for them over time.
Finally, Section 5. Protecting the portfolio. We've built the framework and we have the habits. Now we install the security system.
Because protecting wealth is just as vital as creating it. This security is achieved through strict, non-negotiable diversification across completely different asset classes, combined with maintaining substantial emergency cash reserves. This liquid cash acts as a structural buffer. It ensures you're never forced to liquidate assets at a massive loss during a recession. Contrast this disciplined defense with the disastrous habits that destroy wealth: unchecked speculation, excessive daily trading, dangerous amounts of leverage, and the constant blinding lure of get-rich-quick schemes. Attempting to artificially fast-track your wealth is mathematically the fastest way to destroy it. So, to pull this whole shebang together, let's rapidly fire off these 7 ultimate principles of success. Use this as a checklist to audit your own financial strategy. 1. Are you investing consistently over decades? 2. Are you owning productive, high-quality assets? 3. Have you diversified your risk? 4. Are you actively reinvesting profits? 5. Have you designed systems to avoid emotional decisions? 6. Are you maintaining unshakable long-term discipline? And 7. Are you prioritizing the protection of your capital during market shocks? It is a remarkably focused, systematic, and highly effective roadmap.
Which brings us to the final essential question of this explainer. Are you ready to stop timing the market and start building your blueprint? Because the ultimate takeaway here is that you absolutely do not need access to secret elite investments to become wealthy. You don't need a crystal ball. You just need patience, the math of compounding, and steadfast, disciplined asset allocation. Thanks for joining me on this one, and I'll see you next time.